Hi, welcome to the course of Accounting for Managers. My name is Sajd Iqbal. I'm from Pakistan. I've been done ACCA, Associate Certified Chartered Accountant, and I have been teaching in Dunya University and Swiss UMEF from last 5 years. I welcome you to the course of Accounting for Managers. First, let's discuss about the structure of this course. The structure of the course is divided into 45 minutes, shown in 3 sessions for 15 minutes each. Each lesson is followed by a question and answer session, and same it will be for 15 minutes each. The course is accompanied by test and lectures and the study material which you will get in study pack. After successfully completing the course Accounting for Managers, you will get the grip on the basic concepts that how managers can take benefit from accounting systems. By successfully completing the course, you will get grip on the concepts that how managers can take benefits from accounting systems and principles in the organization. Let's discuss the key aspects of this course. In this course, you will learn about the basics and foundation of accounting for managers. Then you will study that how managers record financial transactions and how they can use it for planning, controlling, and decision making. You will further study about how managers operate a healthy system of controls in the organization to produce solid financial information, and how they make key adjustments in the financial state systems of the organization. At the end of course, you will study about the basic underlying principles of accounting and key elements of financial system, which is considered as important for the managers to understand, and it will help the managers during performing day-to-day activities of their business. Let's have a quick overview of our first lesson, Lesson 1. In this lesson, we will discuss about the introduction for accounting for managers, like any other subject. Then we will discuss who are the internal and external users of financial information, ethics in accountancy, the role of SOX and GAAP in accountancy, how managers analyze business financial transactions so they can use it for planning, controlling, and decision making. Lesson 1, Session 1. Introduction, Accounting for Managers. Importance of accounting. Accounting is a system that identifies, records, communicates information that is relevant, reliable, comparable about an organization activities. If I explain this slide to you, accounting basically is the system which exists in any organization, and the purpose of system is to identify the financial transactions that business is performing on day-to-day basis. Financial transactions is any transaction which affect finance of the organization. Finance simply means about the cash inflows and outflows of the organization. So financial transaction means any transaction which cause cash inflow or cash outflow from the organization. Then that system helps us to record all these financial transactions into our system and then communicate some good information. Good information should have three characteristics. It should be relevant, reliable, and comparable. Relevant basically means that the information that we are communicating to a person, it should be helpful for that person. Reliable means that the information we are providing to a person, it should be trustworthy for that person. And comparable means that information can be compared by one person to the other person, or from one organization to another organization. Now about this good information, to whom we are going to communicate. There can be lots of stakeholders to whom we can communicate. It can be the owners of the business, it can be the customers, it can be the suppliers, bankers, lenders, or anyone. Accounting activities or the accounting system of the organization, we can divide into three steps. Number one, identifying business activities, mean identifying financial transactions for the business. Number two, recording business activities. Whatever financial transactions we have identified, we should record them into our system. And third, communicate it to those that they are interested to collect this information, which we called stakeholders. Users of accounting information. As we have discussed before, that this financial information is collected for the users who will use that information. Why they use this information? Because they have interest in the organization. And anyone who have interest in the organization are called stakeholder or interest holder. There are two types of stakeholders: external stakeholders and internal stakeholders. External stakeholders are those who exist outside of the business. It can be lenders, shareholders, governments, consumer groups, external auditors, or customers. Internal users are basically those who exist inside of the business. It can be managers, officers, sales staff, budget officers, controllers, etc. Now again, let me define you the definition for external and internal users of financial information. External users are those who exist outside of the business. Internal users are those who exist inside of the business and they belong to the internal environment of the organization. Opportunities in accounting. Accounting is now being limited to the bookkeeping anymore. Accounting basically is a very diversified field which can have different contexts. Accountancy can belong to financial accountancy. It can belong to managerial accountancy, which we are going to cover more in this course. It can belong to taxation services or other different types of consultancy services. Ethics. Like any profession, accountants are also required to follow some ethical requirements. Ethics basically anything or any beliefs that distinguish right from wrong. Now, how we can determine that what's right or what's wrong? there are some accepted standards of good and bad behavior, and we have to compare our beliefs or norms with those accepted standard of behaviors. Guidance for ethical decisions. Whenever a manager want to take a decision and he want to determine that whether it's ethical or unethical, there are basically 3 steps of that. Number 1, identify ethical concern. Means that whatever decision we want to take, what are the personal ethics in recognizing that ethical concern. Number 2, analyze options. Manager should see that how many options are available and which options are more ethical or which are least ethical. Third, make ethical decision. Whatever options a manager have, he should choose the best option. This is the way how managers determine that how they can take an ethical decision. Lesson 1, session 1. Here we end our session 1.